Another week, more new highs on the market, at least before the North Korea nuclear holocaust scare kicked in midweek. Is this market unstoppable? Where does it go from here? Lots of strategists on Wall Street still very bullish, but more and more warning flags are coming out. This week in particular, Jeff Gundlach, the legendary bond manager, came out and he said there's a trade that is so obvious, he's describing it as free money. What is that? He is looking at a measure that we've showed you before on the bottom line, the VIX, which measures volatility. It's sometimes referred to as the fear index. Basically, in the past, when the VIX has settled into a level that is as low as it is now, and in fact, it has not been as low as it is now since the 1990s, it has then responded by jumping into huge volatility, usually on the downside. Jeff Gundlach looks at that and says, hey, it is so obvious that scare and fear is going to return to the market that we are going to make something like 400% on our puts. He's betting that over the next few months we'll see a sharp downturn, return to volatility. So a warning from someone who's been right a lot in recent years. Then another much longer term view that we've been talking about is just the valuation of the market. Last week we showed you a chart that showed that valuations across many measures for stocks are now very close to the levels they reached in 2000, right before the big crash. These are the highest levels in history other than that particular point. And valuation, as we've talked about, is useless as a short-term indicator. It doesn't tell you how to time the market, doesn't tell you what stocks are going to do next. They can always get more expensive. But what valuation has been good for in the past is giving you a sense of what your long-term return is likely to be. In short, when you start with a high valuation, as we have today, usually the long-term return is low. When you start from a low valuation, you usually have a high return. So obviously, everybody should keep that in mind. Fund manager John Hussman of the Hussman Funds, who's been very strong on pointing out where we are in valuation, drew an interesting chart last week where he looked at the valuation versus 2000. And one of the big differences there is that in 2000, it was really just the technology stocks that were extraordinarily expensive and dragging up the whole market. Now, as he points out in this chart, the whole market is expensive. Basically, what he's done here is look at each decile of stocks in terms of valuation, top 10%, then the 10 to 20%, and measured them relative to their own valuation over time. And what you see is that although the top sector, the most expensive stocks, are not at their most expensive point in history, pretty much everything else is. And so what's the meaning of that? Meaning is that unlike 2000, where if you moved out of technology, there were other places in the market where you could be comfortable that you had some valuation protection. Here, there really is nowhere to hide. So what does that mean for you as an investor? What should you do? What smart advisors will tell you to do is just simply manage your expectations. Realize that where we are, what could happen given where we are, which is a sharp downturn. So have the right outlook. And then secondly, and most importantly, just balance your portfolio such that you're able to weather a downturn if we get it. That is always a good strategy, and that is what folks would recommend. I think you would not find any smart advisor saying, hey, you got to get out of the market or what have you. We just can't time it that carefully. So stay balanced, understand what your expectations are, and we'll obviously follow the valuation story going forward.